All right. Wednesday, once again. Wednesday, once again. And we're up here talking about wealth on Wednesday. Glad to be here. Glad to be with you. Hope you can get something out of this and take it home with you. Take it right to the spot and get what you need. We're talking about simple ways to diversify your income for building wealth. Simple ways to diversify your income for building wealth. And I like this in the sense of I like talking about income investing. And a lot of people, when they think about income investing, they think about different stuff that may or may not apply. And I want to help somebody out. You've heard me mention some high yield investments that may or may not fit your criteria. Well, that's okay. And that's going to be okay because you've got some options, right? You've got some options to do some things here. And I want to share with you just a few things you can do income investing that'll get us going. All right, let's talk about this. First off, when it comes to income investing, things and letting that sit and not talking about getting into much of anything else, but I want to think about diversification as well as allocation. Think diversification and allocation. And when I say that, that means allocation first. Where are you allocating the amount that you're investing into different sectors, right? Large cap, mid cap, small cap. For instance, if you're investing in dividend aristocrats, those tend to be more large cap, some mid cap funds. If you're thinking about dividend investing into foreign companies, a lot of foreign companies pay high yields, but there's also a different amount of risk that goes there. So your allocation means how much you're allowing to go into each of those sectors, and your diversification is the sectors that you actually cover, right? Are you in the real estate without buying property, real estate investment trust, things of that nature? Those are all different ways to look at it. I want to put it in perspective here. Um, when we talk about REITs, there's two ways to get into REITs, and REITs are um, real estate investment trusts. And I think that we need to look at REITs in this sense: those that you can get that are already diversified REIT companies that are diversified or even unique, and those that are companies that are, you have vanilla companies, right? Ticker symbol O, right? Realty income, right? That is the dividend investment company. That is the company that pays a monthly dividend, right? That a whole bunch of people know about, that people are gung ho about. They'll swear by it. I'm one, you know, never done me wrong, constantly increasing the dividends, and I've been invested with them for over a decade, right? Why? Because the company delivers, and they've been pretty consistent in their delivery. What happens a lot of times is we'll end up with companies that are inconsistent with their delivery, and people are still buying into them, right? So when I buy REITs, I buy both stocks and ETFs. And like I mentioned, ticker symbol O is one. But what I also look at is there are REITs that are available. Invesco, right, offers a REIT ETF that I like, and that ticker symbol is KBWY. KBWY. And that one is diversified. It's cheap to get into, pays monthly, expense ratio is decent. It's not really low, but it's, like I said, it's decent for what you get in return, right? If I'm getting 6-8% dividend yield and I'm being charged less than 1%, I'm cool, right? That means I'm getting 5 to 7% back. Cool. I'm gaining along with whatever gain that company may make. And so I think real estate is definitely an investment that you need to get into. It doesn't have to be property, right? And I know a lot of people selling property, but property comes along with the headaches of management. Property management is a main key. And so if you buy REITs, you don't have to worry about property management. Someone else has to worry about that headache. But REITs, the ETFs, give you diversification and allocation in one bundle. The stocks give you what's unique. For instance, if you look at Iron Mountain, right? Iron Mountain is a REIT. Iron Mountain, the company that shreds your documents, stores your data, that's a REIT. And so they pay out, like any other REIT, a percentage of their profits. And so that's the type of company individually I buy, right? When I look at REITs, I think of storage, right? When I think of storage, I think of Public Storage, which is a popular storage company, right? And Public Storage is a REIT, as well as self-storage and Cube. Those are all REITs. And so thinking about these as how they offer paybacks, and as individual companies, they're unique. But as ETFs, you can get greater diversification. And so when you go to start building, perhaps you start with an ETF. You start with ETF, like I said, KBWI, or another one that's a decent one, Global X, as well as you got REITs that come from iShares, Vanguard, VNQ. Those are all REITs. And so that's one way I would think about investing for diversification long term. Get into real estate on an angle. Another one is bonds or bond ETFs. And I'm really saying this as far as bond ETFs because one of the things I've found out as I've gone forward is that bond ETFs, you can also go through iShares and get laddered bond ETFs. They're already laddered for you, and they're broken down into I bonds, they're broken down into government bonds, treasuries, they're broken down into corporate and high yield. And you don't have to worry about maturity dates. When it comes to bond investing, maturity dates tend to impact your investment yield. But if you're getting 5% on a bond ladder paid monthly, you're hitting it. You're hitting the number that you want because you're getting more than you would get if it was sitting in the bank. And if you're getting older and you want that conservative diversification along with the income, that's me, I'm getting older, take it in that form. You don't have the risk and volatility of the stock market. What you do have is the risk of maturity. And with bond ladders, now it's on the fund manager. And so you will pay a fee, but the fee's worth it if you're not chasing down to see when your maturity dates are coming up. That's what's key there. I wouldn't buy treasuries directly from the government because things change, rates change, and I don't want to do all the work. Let the fund manager do it. That's the other place I would go. And thirdly, here's a place where you can diversify and not have any problems as far as income. Preferred stock ETFs. And I'm not saying buy individual preferred stock. I'm saying buy preferred stock ETFs. I mentioned again Invesco, right? Also Global X and iShares. Those are just some examples of preferred stock ETFs that are paying 6%, sometimes higher, depending on what's going on. Because think about it, companies that pay or offer preferred stock are pretty solid companies that want another avenue, another level of investors. And this used to be a very old school system, but as we've gotten into the new age of investing, a lot of people have gotten away from preferred stocks. So preferred stock bundles that come in ETFs are paying, like I said, 6%, sometimes higher. That's another avenue when you create that allocation and that pie chart. That's where you want to get that allocation of diversification, preferreds versus bonds. So you can have it to where if bond rates drop, preferreds remain the same, you're still pulling in that income. You want that income coming in. And that income is definitely something that you want to keep a hold of. And this one is the controversy. The controversy emerges. Dividend stocks versus dividend ETFs. Dividend stocks versus dividend ETFs. When it comes to wealth building, people will tell you the argument between dividend stocks versus dividend ETFs, stocks versus real estate. Which one pays out better? Look at your time horizon one. Look at the amount that you're targeting as far as income. Not that the amount that you're targeting for investment, but the amount that you're targeting for income. And then create an investment plan on that. And don't chase the yield. Check the value of the company and the ability to deliver on that yield. That's what I'd say. So if you're going to do individual stocks, for me, I get the Dow dogs, the dogs of the Dow. And those are the 10 highest yielding stocks that are in the Dow 30, right? And those typically change from year to year, but you're going to get your Johnson & Johnsons, your Nikes, your Dow Chemical, 3M, companies like that are providing dividends on a consistent basis. Will you get dividends? You typically won't get dividends over, I think IBM at one point was 6%. You're not going to get dividends beyond that. Verizon is at 6%. You're not going to get dividends beyond that 6, maybe 7% yield. That's rare. Cisco's in there. They're not that high. But they're still high quality companies that fund investors need to buy if they're investing in the market. And a lot of these companies are also part of the S&P 500. So that makes sense. Beyond dogs of the Dow, I would also say dividend ETFs, diversified dividend ETFs that invest in dividend kings, dividend aristocrats. Those tend to pay 4%, 5% yield. I love a few, SPHD, DHS, right? DGRW. These are just some of the ones that I love to dig into and get paid monthly. I'm not trying to I'm not trying to deal with this and wait quarterly for a lot of payments. I do like SEHD in some of my long-term, retirement accounts, but I'm not putting SEHD in a lot of my taxable accounts because I'm trying to generate and accumulate funds, right? I'm trying to do that rapidly. And so getting that monthly income then allows me to reinvest it and compound it rapidly as opposed to on a quarterly basis. That's the difference in my approach. I try to look at it monthly. There are ETFs that pay weekly. I don't necessarily recommend a lot of them, but there are ETFs that pay weekly. And I say, do your research. Find out if that fits for you. But if you get it weekly, remember it's going to be less of a distribution because they're making 52 payments, not 12. And so don't be shocked when you're like, oh, I only got such and such this week. Well, yeah, you're going to get some more next week. So by the time you complain about what you got on Friday, on Wednesday, you get another announcement that this Friday you get another hit. So you got to weigh it out. You got to weigh it out and see what works for you. And when you weigh it out and see what works for you, that's when you begin to say, okay, based upon my plan, here's where I'm headed. Here's what I got going on. God bless. I think this is working for me. It may or may not work for you. Don't get upset. Don't break down. But I think these areas, real estate, bonds, ETFs that are focused on preferreds and dividends, I think these are areas where if you put your focus and allocate properly and diversify and then have enough cash for comfort, right? I think that's the thing we don't always consider. Do you have enough cash for comfort? And cash for comfort means if all this stuff goes haywire, do I still have enough cash to say, okay, let me pay a few things down and continue investing towards my goal? Let me continue moving in a direction towards the accumulation that I want to have. And the accumulation is you're building the core funds that will generate more income. Your money is making money. And so, yeah, I would say you need a certain level of cash for comfort. And that cash for comfort can be in a high yield savings account. It can be in a money market mutual fund. It can be in a mix of savings, mutual funds, as well as CDs. A lot of these promotional CDs out there are doing good. I mentioned previously about AXOS, and their bank account, their Summit bank account, right? Something to check out. There's a link. If you're on YouTube, there's a link in the description that'll give you a bit of the information, right? That is going to tell you how to get that AXOS account. It's a referral link. There's referral links for Stash, Robinhood. You want to get invested and you want to get diversified. And once you're diversified as an investor, there's really no stopping you. You just have to manage it. And managing it takes research, it takes time, and you have to be aware of not so much the market conditions, what's changing in your life. Can you ride what you currently have for the next 5 years, 10 years, 15 and beyond? What are you trying to do? For what I'm trying to do as far as an income investor, I'm trying to continue to allocate for 5 more years and let that thing move 10 years after that on its own. And the rest is retirement. And what does my retirement look like? Index funds. But you want to get to where you have cash for comfort. And I think the cash for comfort for some people will vary based upon their situation. Do you still have a mortgage? Are you still paying down debt? Are you about to send some kids to college? Don't risk it all on leap options and leveraged ETFs and all this stuff that's delivering today but may not pay off when you need the cash immediately. You got to have a plan. And if you're going to be doing income investing along with options, you need a plan, a strategy that works and places you in a position to where your next move is your best move. And I say that because once you get the cash from certain transactions, then you've got to be able to reallocate that into other investments so your money continues making money, not just sitting on the side. Hey man, I hope this helps. I'm just trying to give you a few bits and pieces to help you get some more money down the road. Just a few bits and pieces. Just a tidbits, a little bit right here and there. And hopefully this will get us in a position to where we can have wealth that we can pass on, wealth that we can continuously give to our loved ones. Think about it. Financial literacy leads to financial freedom. Learn how to master your money and not die broke. God bless.